course, the investment team was hard at work the entire week. And in fact, we ended Friday on a positive note because we got some really good news from average hourly earnings. And so this is going to sound counterintuitive, but average hourly earnings went down, and the market really rallied from that news.
Well, they're down from what they were on a year-over-year basis. They're up 0.3% in December. The other thing that was really interesting is November was revised down, too. People freaked out on that November wage gain of 0.6. They actually revised that down to 0.4. And the other thing that's extraordinary is, given all this talk about a recession, the U.S. economy added 223,000 jobs in the month. The unemployment rate is now back to 3.5%. Despite the fact that the labor force expanded by 439,000 workers.
Yeah, and so, of course, the Fed is really in a conundrum, as we have covered very well, is that they're trying to lower demand because they really can't do anything on the supply side. So they're trying to do what's called demand destruction, slow things down. But on the other side, Derek, we saw a number of numbers that do suggest that the slowing is on top of us. We saw this ISM number. It has contracted on the manufacturing side, and now we saw a services number, ISM services number, that has gone from 56 to under 50 to about 49. Both of those suggest that the manufacturing and service industries are contracting.
Right, and we've seen the same thing from the housing market. New home sales down dramatically. The average sale per realtor at record lows in terms of home sales. So the housing market is rolling over. That has secondary and tertiary impacts. So the economy is clearly slowing, and this very well may be what a soft landing looks like. Modest job gains, modest wage pressures, but yet inflation continues to abate.
And that will be funny, Derek, because if a recession happens, it'll be the most widely anticipated recession. And if it doesn't happen, that means the contrarians were right again, that maybe we have just a slowing down or a soft landing. But right now, the key is, and what we're looking at, is when is the Fed done raising rates? And so if all of these things are trying to slow down, then they're doing their job, right? So if the manufacturing is starting to contract, if services are starting to contract, if payroll numbers are starting to look better, that means that perhaps February and maybe a 25 basis point hike in February might be the last. And folks, remember, the stock market bottoms long before the economy does.
And that was amplified by the FOMC minutes. In those minutes, no one in the committee expected rate cuts in 2023. They all agreed on the need for aggressive rate increases. So that you either believe the Fed or you don't. People believed the Fed during the bull market were rewarded as they injected liquidity in the system. Now they're taking liquidity out. They're telling you they're going to be hawkish. So you really have to have kind of a playbook in which to negotiate this, as you mentioned, because certainly the market will celebrate if it appears they are pausing these rate hikes.
And that's the key word, pause. And so we talked a lot about what are the words we're going to look for in 2023, and pause versus pivot. What does that mean? That they're going to pause their rate increases. And of course, they had 7 in 2022, and one highly likely next month in February. And then do they pause raising the rates? The pivot, folks, means that they're going to turn around and start lowering rates. I find that very unlikely.
Well, and the other thing, you be careful what you wish for, because if the Fed starts to lower rates, it's because the economy is rolled over and they see an accident about to happen, or perhaps it already has. The other wild card, obviously, in 2023 is oil prices. They've come down substantially. We all know that from going to the gas pump. And that could change very quickly as China is reopening.
And, of course, China is reopening, and it's going to be dramatic, of course. They have still had these COVID restrictions. They are lifting them, which probably means COVID is going to run rampant through China, but that also means the economy is going to open up, so that will be a story throughout the year as well.